Good morning. These are the things that matter most for the U.S. pre-market. Treasury officials are floating a near $1 trillion cash account backstop for bond buybacks. NVIDIA and the AI trade face a price and infrastructure proof test. Canada trade tensions are lifting U.S. steel names while pressuring cross-border risk. And UPS is putting $2 billion behind healthcare and international supply chains. The central market question is simple. Can Wall Street broaden beyond the AI leaders if rates, trade policy, and logistics margins are all testing the same market at once? Start with the Treasury market. CNBC reported that Scott Bessent could tap the Treasury General Account, close to $1 trillion, to fund bond buybacks, while MarketWatch highlighted that the post-war bond yield regime may be shifting higher. That matters because a buyback headline can calm the tape for a morning, but the deeper issue is whether investors believe the U.S. debt and duration supply problem is being managed rather than postponed. The cleaner side is cash-rich megacaps, high-quality duration growth, and bond-sensitive sectors if yields settle. Pressure sits with regional banks, small caps, and homebuilders if long yields keep rising. For private investors, the useful filter is whether TLT, KRE, and the homebuilder basket confirm the same message as the Nasdaq. Second, the AI trade is becoming a price and infrastructure proof test. CNBC reported that NVIDIA customers were warned about AI-related price hikes, and also noted that what is bogging down the data center trade has little to do with demand. MarketWatch added that NVIDIA results and Jackson Hole make this a critical week for markets. In plain English, AI demand can be strong and still produce pressure if power, memory, networking, and customer budgets become the bottleneck. Potential beneficiaries sit with NVIDIA, Microsoft, and the highest quality AI infrastructure chain if pricing power survives. Pressure can show up in thin-proof AI labels, cloud customers facing higher input costs, and software names that need AI spending to translate into revenue. The private investor takeaway is to separate AI demand from AI margins. Both have to work for the trade to broaden. Third, the Canada trade war headline is not just a currency story. CNBC reported that the Canadian dollar slid as Ottawa and Washington headed toward an all-out trade war, and Yahoo Finance showed U.S. steel stocks Nucor and Steel Dynamics rallying as Canada trade talks collapsed. That matters for Wall Street because tariffs and supply chain friction can create clear winners in one industry while raising costs for manufacturers and transport users elsewhere. The cleaner side is U.S. steel and some domestic industrial capacity. Pressure sits with cross-border manufacturers, car-related supply chains, and companies exposed to weaker Canadian demand. For private investors, the practical takeaway is this. Trade tension can be market positive for a protected sector and still market negative for breadth. Fourth, UPS is the underappreciated logistics margin story. CNBC reported that UPS is investing $2 billion in international, healthcare, and supply chain businesses. The hidden mechanism is mixed quality. Investors often treat package volume as the whole UPS story, but healthcare logistics, international lanes, and supply chain services can change margins even when the consumer parcel cycle is uneven. The cleaner side is UPS, healthcare logistics providers, and high-value supply chain services if execution improves. Pressure sits with lower margin parcel competition and retailers that depend on cheap fulfillment. The private investor filter is not to call UPS a simple macro cycle bet. Watch whether the market rewards higher quality logistics revenue. Here is the stock-led watch list. TLT, KRE, and DR Horton ask whether the Treasury backstop is actually easing rate pressure. NVIDIA, Microsoft, and Broadcom ask whether AI pricing power broadens beyond one earnings event. Nucor, Steel Dynamics, and Caterpillar ask whether trade tension is a sector tailwind or a cost shock. UPS, FedEx, and Amazon ask whether logistics mix quality can offset consumer delivery pressure. Market bias, selective and proof-driven. A constructive Wall Street open needs more than one AI rescue headline. It needs calmer yields, cleaner breadth, and fewer margin surprises. The mistake to avoid is flattening every headline into bullish or bearish. Treasury buybacks, AI price hikes, trade protection, and logistics investment each work through different channels. That is the U.S. pre-market brief. We will be back tomorrow at the same time with everything that matters. Research context only. This briefing is not investment advice.